There is a promise whispered in the stock market, a siren song that has lured millions of investors to financial ruin. It's a simple promise, printed in bold ink at the bottom of every quarterly earnings report, broadcast on every financial news network, and celebrated by analysts and executives alike. It is the promise of profit, net income, earnings per share. This single number is held up as the ultimate scorecard for a business, the definitive measure of its success. We are taught from our first lesson in investing that companies that make a profit are good, and companies that make a bigger profit are better. This number dictates the rise and fall of stock prices, makes and breaks corporate careers, and forms the foundation of what most people consider to be sound financial analysis. And according to Warren Buffett, the most successful investor in human history, it can be one of the most dangerous illusions in the entire world of finance. He has built a multi-hundred-billion-dollar empire, not by chasing this celebrated number, but by focusing on a different, far more honest metric. A number that cannot be easily manipulated, a number that represents the cold, hard, physical reality of a business. That number is cash. The final promise that a business makes to its owners is not a profit on a spreadsheet, but cash in their pocket. And the costly mistake that this focus prevents is investing your life's savings into a company that looks like a shining star on the surface, reporting record profits, only to discover too late that it was a financial mirage, a machine burning through cash on a silent, one-way trip to bankruptcy. The financial transformation you are about to undergo is profound. You will learn to stop being a passive consumer of financial news and become a financial detective. You will learn to follow the cash, to read financial statements not as accounting documents, but as a story of a company's true health. This skill will protect you from the market's most devastating blow-ups, allowing you to sidestep the landmines that vaporize the portfolios of amateur investors. This is more than just financial education. This is the key to portfolio protection, the foundation of true wealth management, and the first step toward achieving genuine financial freedom. The great illusion of modern finance begins with a single document, the income statement. It's the first thing most investors look at, the source of that all-important number, net income. But to understand why this number can be so misleading, we must first understand what it actually is. Net income is not a pile of money. It is not a physical thing. It is, in the words of Warren Buffett, an accountant's opinion. And that opinion is shaped by a set of rules and assumptions known as Generally Accepted Accounting Principles, or GAAP. These rules allow for a great deal of flexibility. For example, a company makes a huge sale at the end of a quarter. The customer hasn't paid yet, but under accrual accounting, the company can book that sale as revenue, and therefore as profit. The profit is on the books, but the cash is not in the bank. A company buys a massive $100 million machine. They don't have to record that $100 million cost all at once. Instead, accountants get to make an assumption about how long that machine will last, say 10 years, and then they spread that cost out over a decade, recording only a $10 million expense called depreciation each year. This makes the company's reported profit for this year look $90 million better than its cash reality. These are not illegal tricks, they are standard accounting practices, but they create a gap, a chasm, between reported profit and actual cash. And it is in this chasm that danger lurks. The perfect harrowing illustration of this danger can be found in the story of a company that, for a time, was the absolute darling of Wall Street, a titan of the new economy that promised to reshape the world, WorldCom. In the late 1990s and early 2000s, WorldCom was more than just a company, it was a phenomenon. Led by its folksy cowboy boot-wearing CEO, Bernie Ebbers, it had grown at a dizzying pace, swallowing up competitor after competitor to become the second-largest long-distance phone company in the United States. Its stock was a rocket ship, a core holding in millions of retirement portfolios. And why not? The company's income statement was a work of art. Quarter after quarter, WorldCom reported staggering, ever-increasing profits. In the year 2000, for instance, the company reported a net income of nearly $4 billion. It was the picture of corporate health, a testament to the power of executive decision-making in the booming tech and telecom sector. But beneath this beautiful surface, the company was rotting from the inside out. The core business was struggling. The promised synergies from its dozens of acquisitions weren't materializing. The immense pressure to keep meeting Wall Street's insatiable demand for higher and higher profits led the company's executives down a dark path of accounting fraud. Their method was devilishly simple and exploited the very gap between profit and cash that Buffett warns about. They began to treat their day-to-day operating costs, the money they spent just to keep the lights on, what were known as line costs, as capital expenditures. In the world of accounting, this is a cardinal sin. An operating cost, like an electricity bill, must be subtracted from revenue immediately, reducing your profit for that quarter. A capital expenditure, like buying a new building, is an investment in the future, and its cost is spread out over many years through depreciation. By fraudulently reclassifying billions of dollars of operating costs as capital expenditures, WorldCom performed an act of accounting alchemy. In 2001, this trick alone artificially boosted their reported profits by over $3.8 billion. The income statement showed a handsome profit. The reality was a catastrophic loss. The retail investor, the person saving for retirement or their children's college education, would look at the earnings report and see a thriving, profitable enterprise. They would see the analysts on television celebrating another earnings beat. They would feel reassured. But a detective, an investor with a CEO mindset who knew to follow the cash, would have seen the red flags waving violently. The clue was buried in the cash flow statement. Even with the fraud, the company's cash flow from operations was lagging far, far behind its reported net income. The cash just wasn't there. The company was constantly raising money by issuing new debt and new stock, not to fund exciting new growth, but simply to pay its bills. When a tiny team of internal auditors, led by a woman named Cynthia Cooper, finally uncovered the fraud in mid-2002, the illusion shattered overnight. The company filed for what was then the largest bankruptcy in U.S. history. The stock, which had traded at over $60 a share, became worthless. Billions of dollars in shareholder wealth, in retirement savings, in dreams for the future, evaporated in an instant. The promise of profit, so beautifully printed on the income statement, was revealed to be a lie. The unforgiving truth of cash had the final say. The WorldCom disaster is a dramatic example of a deep-seated psychological flaw that affects almost every investor. We are all susceptible to what psychologists call the anchoring bias. This is our tendency to rely too heavily on the first piece of information we receive when making a decision. In investing, that anchor is almost always the earnings per share, or EPS, number. It's the headline. Company X beats earnings by 5 cents. Company Y misses estimates. This single, clean, easily digestible number becomes the anchor point for our entire valuation of the company. We anchor to it, and we rarely question its validity. This is compounded by the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are not built to process raw, complex data. We are built to understand stories. The income statement, with its headline profit number, provides a simple, compelling story. This company is a winner. The cash flow statement, with its messy, multifaceted details about operations, investing, and financing, is not a simple story. It's a complex, nuanced reality. So we gravitate toward the simple story, the beautiful illusion of profit, and we ignore the complicated truth of cash. Warren Buffett's entire approach is designed to shatter this psychological trap. He actively resists the anchor of the EPS number. He knows it's just an opinion, a starting point for a much deeper investigation. His mindset is not that of a stock picker, it is that of a business owner. And a business owner knows that you can't pay your employees with opinions. You can't pay your suppliers with accounting assumptions. You can't reinvest in your business with accruals. You can only do those things with cold, hard cash. To break free from this trap, you must adopt a new mental model. I call it the accountant versus owner framework. When you look at a set of financial statements, your first job is to stop thinking like a passive recipient of the accountant's report and start thinking like the sole owner of that business. The accountant's job is to follow the rules of GAAP to produce a number called net income. Your job, as the owner, is to figure out how much cash the business actually generated for you, the owner. Here is the blueprint, the step-by-step process to apply this model. Step 1. Open the company's quarterly or annual report and find the income statement. Look at the very bottom line, net income. Acknowledge the number, and then immediately treat it with extreme suspicion. Step 2. Ask yourself a critical question. What are the largest non-cash items that are affecting this number? Scan up the income statement. The most common and often the largest is depreciation and amortization. Remember our factory machine example. This is a purely theoretical accounting expense, not a cash outlay for this period. In your mind, you must add this number back to the net income to get closer to the cash reality. Step 3. Now ask the second critical question. What are the largest cash expenses that are not fully captured on this income statement? The biggest one is almost always capital expenditures or CapEx. This is the real money the company had to spend this year on new factories, machines, and equipment, just to stay competitive. You'll find this number on the cash flow statement. This is a real cash drain that the accountant's net income number conveniently smooths out over many years. Step 4. You must state your mission clearly in your own mind. My goal is not to accept the accountant's opinion. My goal is to reconcile that opinion with the cash reality of the business. This conscious shift in perspective is the most important step. You are no longer a spectator. You are a detective, and net income is your first, untrustworthy witness. You are on a mission to find the truth, and the truth lies in the flow of cash. This mental shift is what separates the successful investor from the 99% who perpetually underperform. The path of the 99% is paved with an obsession over reported earnings. The average retail investor turns on the financial news, hears that a popular tech company beat earnings by 2 cents, and interprets this as a definitive buy signal. They log into their brokerage account and place an order without ever looking at a financial statement. They are reacting to the story, the narrative that has been anchored in their mind. They might see that the company has a high price-to-earnings ratio, but they dismiss it, thinking it's just the price you pay for a great growth company. They never stop to question whether the E in that PE ratio is real or an accounting fiction. This behavior reached its zenith during the dot-com bubble of the late 1990s. An entire generation of investors piled into companies that had never produced a single dollar of positive cash flow. These companies were celebrated for their eyeballs, their user growth, and their market share. They reported massive losses, but the narrative was that immense profits were just around the corner. Investors ignored the fundamental question: does this business actually generate cash? The result was a historic collapse that wiped out an estimated $5 trillion of market value. The 99% who chased the story were financially devastated. The handful of investors who, like Buffett, remained disciplined and focused on the unglamorous reality of cash flow not only preserved their capital but were able to buy incredible businesses at bargain prices during the aftermath. The path of the 99% is to chase the illusion. The path to wealth is to follow the cash. The direct financial connection here is about avoiding the single biggest destroyer of capital, overpaying for an asset based on flawed information. Imagine two companies, Company A and Company B. Both report a net income of $100 million. To the investor focused on profits, they might appear equal. But then you, the financial detective, dig deeper. You discover that Company A, a software business, had non-cash depreciation charges of $10 million and only had to spend $5 million in capital expenditures on new servers. Its real cash generation was roughly $105 million. Now you look at Company B, a heavy manufacturing business. It also had depreciation of $10 million. But to keep its aging factories running and competitive, it had to spend a staggering $120 million in capital expenditures. Its real cash reality wasn't a profit of $100 million. It was a cash loss of $10 million. An investor who pays a multiple of Company B's profits is lighting their money on fire. They are buying a business that is consuming more cash than it produces. This is the core of portfolio protection. By learning to distinguish between accounting profit and cash reality, you build an impenetrable defense against these value traps. This single skill prevents you from making the catastrophic mistakes that force most people out of the market. It ensures your capital lives to fight another day, to be deployed into genuinely healthy businesses, and to compound for your long-term financial freedom. The income statement can tell you a story, but only by understanding its connection to cash can you determine if that story is fact or a very expensive fiction. If the income statement is a potentially misleading opinion, then the cash flow statement is the source of unforgiving truth. This is the document that bridges the gap between the accountant's world and the real world. It doesn't care about assumptions or depreciation schedules. It is a simple, brutal record of all the cash that entered the company's bank account and all the cash that left it over a period of time. It is the heartbeat of the business, the EKG that reveals its true health. For Warren Buffett, mastering this document is not just a part of his stock analysis, it is the absolute foundation of it. And there is no better story to illustrate his devotion to the truth of cash than his 1972 purchase of a humble, family-owned chocolate company called See's Candies. At the time, Berkshire Hathaway was a very different company, primarily a struggling textile manufacturer. Buffett was looking to deploy the capital from this dying business into something wonderful. He and his partner Charlie Munger were introduced to the See family, who were looking to sell their beloved California-based candy business. The numbers were straightforward. The company was earning about $2 million in profit after tax, and it had about $8 million in tangible assets. The See family was asking for $30 million, but Buffett managed to negotiate them down to $25 million. By conventional metrics of the time, this was no great bargain. He was paying more than 3 times the company's book value and a fairly high multiple of its earnings. In fact, Charlie Munger initially thought they were overpaying and was very hesitant. He, like most investors, was still anchored to the numbers on the income statement and balance sheet. But Buffett saw something else. He saw a reality that was not fully captured by those documents. He saw the cash. Buffett's deep dive into See's financials revealed a magical business model. See's Candies sold a premium product that commanded incredible brand loyalty. Because of this loyalty, they could raise their prices a little bit each year to cover inflation and then some, and their customers would happily pay. But the true magic was on the cash flow statement. To produce more chocolates and sell more boxes, See's did not need to build massive new factories or invest in expensive, cutting-edge technology. The business was not capital-intensive. It generated far more cash from its operations than it ever needed to spend on capital expenditures just to maintain its competitive position. It was a gusher of cash. Furthermore, the business had a unique cash conversion cycle. Its busiest season was Christmas. Customers would come in throughout December and pay cash for their boxed chocolates. See's would collect all this cash up front, but they wouldn't have to pay their suppliers for the sugar, chocolate, and boxes until January or February. This meant that for a crucial part of the year, the business was effectively getting a massive, interest-free loan from its customers and suppliers. It was a cash-generating machine of the highest order. Buffett realized he wasn't just buying $2 million in annual profit. He was buying a business that would soon be producing $5 million, then $10 million, then $20 million in spendable cash, year after year, without requiring him to reinvest much of it back into the business. That initial $25 million investment has since produced, in aggregate, over $2 billion in cash for Berkshire Hathaway. That cash became the seed corn for countless other investments, from Coca-Cola to American Express to the BNSF Railroad. The purchase of See's Candies, a decision based not on reported profits, but on an analysis of its future cash-generating power, transformed Berkshire Hathaway and cemented the principle that would guide every major investment decision Buffett would ever make. Cash flow is the ultimate reality. This relentless focus on cash is a powerful way to overcome a dangerous psychological trap known as confirmation bias. This is our natural tendency to search for, interpret, favor, and recall information that confirms our pre-existing beliefs. If an investor decides they like a company, perhaps they like its products or its charismatic CEO, they will subconsciously look for data that supports their decision to buy the stock. The income statement, with its often rosy picture of profitability, is the perfect source of this confirmation. See, the investor tells themselves, the company is making a lot of money. My initial belief was correct. This is a recipe for disaster. Buffett's approach forces him to do the opposite. He employs first principles thinking. Instead of starting with existing assumptions, he breaks everything down to its most fundamental truth. And the first principle of any business is this: a business is fundamentally worth the sum of all the cash it can produce for its owners from this day until Judgment Day, discounted back to the present. That's it, that's the entire game. The cash flow statement is the closest any financial document comes to revealing this fundamental truth. It is a record of the actual cash the business has produced. By starting his analysis there, Buffett is not looking for confirmation of a pre-existing belief. He is seeking objective reality. He is forcing himself to confront the unvarnished facts of the business, whether they are pleasant or not. This protects him from falling in love with a story and grounds his financial analysis in the bedrock of what truly matters. To apply this first principles approach, you need a practical mental model for dissecting the cash flow statement. The best way to do this is to see the document not as a jumble of numbers but as a story told in 3 distinct chapters, or what I call the 3 buckets. Bucket 1 is cash flow from operations, CFO. This is the first and most important section. It tells you if the company's core day-to-day business is actually generating or consuming cash. This is the engine of the entire enterprise. A green flag here is a CFO that is strong, positive, and ideally growing over time. A massive red flag is a negative CFO, which means the company's main business operations are losing cash, or a CFO that is consistently lower than the net income reported on the income statement. This bucket tells you if the business model fundamentally works. Bucket 2 is cash flow from investing, CFI. This chapter of the story tells you what the company is doing with the cash it generates. A negative number here is often a good sign. It means the company is investing in its future by spending cash on new factories, equipment, or acquisitions. This is capital expenditure. A consistently positive number here is a potential red flag. It could mean the company is so desperate for cash that it's selling off its assets, its factories and equipment, just to stay afloat. This bucket reveals the company's strategy for the future. Is it building or is it liquidating? Bucket 3 is cash flow from financing, CFF. This final chapter tells you how the company interacts with its owners and lenders. A positive number here means the company is taking in cash by either issuing new debt or selling more of its own stock. This can be a sign of a company in distress, one that needs outside capital to fund its money-losing operations. A negative number here is often a very good sign. It means the company is using its cash to pay back debt, which strengthens the balance sheet, or to return cash to shareholders in the form of dividends and stock buybacks. This bucket tells you if the company is funding itself through strength or weakness. By analyzing the story of these 3 buckets together, you get a panoramic view of the business's health that is infinitely more valuable than a single profit number. The 99% of investors who ignore this 3-act story often get burned by focusing only on the top-line growth narrative. Consider the case of a high-growth, subscription-based company, like Peloton, during its pandemic-era peak. The narrative was electrifying. Revenue was exploding. The company was becoming a household name. On the surface, it looked like an unstoppable force. But the path of the 99% was to buy this narrative without reading the full story told by the cash flow statement. Had they looked at the 3 buckets, they would have seen a much more troubling picture. In the cash flow from operations bucket, they would have seen that while revenue was soaring, the company was spending colossal amounts of cash on marketing and building up a massive inventory of unsold bikes and treadmills. The core business was not generating as much cash as the revenue growth would suggest. In the cash flow from investing bucket, they would have seen enormous negative numbers as the company poured billions into building new factories and infrastructure to meet a temporary surge in demand. And in the cash flow from financing bucket, they would have seen that this entire operation was being funded by taking on huge amounts of new debt and issuing new stock, diluting existing shareholders. The story was great, but the cash reality was that of a business burning through capital at an unsustainable rate. When the pandemic-era demand inevitably faded, the cash reality asserted itself, and the stock price collapsed by over 95%, wiping out investors who had fallen in love with the income statement's growth story. The cash flow statement was screaming a warning, but only those who knew how to listen were protected. The direct financial connection of mastering the cash flow statement is that it allows you to identify what Buffett calls the great business. A great business is one that has a consistently strong and growing cash flow from operations, allowing it to fund its own growth, its negative cash flow from investing, without needing to take on debt or issue stock, a positive cash flow from financing. This is the holy grail of value investing. A business that can fund its own growth from its own operations is a self-sustaining compounding machine. It develops what Buffett calls a quote 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 quote. It can weather economic downturns with ease, while its weaker, debt-laden competitors struggle. Most importantly, once its growth needs are met, it can use its excess cash to reward shareholders through dividends and buybacks, which directly increase shareholder returns. This type of business is the cornerstone of any sound wealth management strategy. Your goal as an investor isn't just to find companies with growing profits, it's to find businesses that are self-funding cash machines. This provides not only higher capital gains over the long term, but also a profound level of portfolio protection. Cash-rich businesses don't go bankrupt. By learning to read the story of the three buckets, you equip yourself to find these financial fortresses and make them the bedrock of your personal portfolio. We've established that reported profit is an opinion and that cash flow is the fact. But even within the world of cash flow, there's a level of nuance that separates the good investor from the great one. Warren Buffett wasn't satisfied with the standard definition of free cash flow that most analysts used. He felt it didn't accurately represent the true economic reality of a business owner. So, in his 1986 letter to Berkshire Hathaway shareholders, a document that has since become a sacred text for value investors, he unveiled his own, more precise formula. He called it owner earnings. This concept was born from his deep frustration with how other companies were presenting their financial results. He saw executives celebrating record profits while ignoring the enormous, ongoing capital expenditures required to keep their businesses competitive. They were treating depreciation, that small, non-cash accounting charge, as if it were the only cost of maintaining their assets. Buffett knew this was nonsense. He knew that for many businesses, the real cost of replacing and upgrading equipment was far higher than the tidy depreciation number on the income statement. This intellectual honesty drove him to create a tool, a detective's magnifying glass, to cut through the accounting fog and calculate the true, spendable cash an owner could theoretically pocket at the end of the year. The story of owner earnings is the story of Buffett's quest for a more honest number. In his 1986 letter, he used the analogy of a hypothetical business to explain the problem. Imagine you and a partner own an apartment building. The building cost you $1 million and will last for 50 years. The accountant would tell you to record a depreciation expense of $20,000 per year. If your rental income minus all your operating costs is $100,000, your reported profit after depreciation would be $80,000. Many business managers, Buffett argued, would then look at that $80,000 profit and think they could spend it all. But as the owner, you know the truth. The building is getting older every year. The roof will need replacing, the plumbing will fail, the facade will crumble. You know that to keep the building in good condition and competitive with newer buildings, you will have to spend real cash on maintenance and upgrades over time. This real cash spending, which he called maintenance capital expenditures, might average, say, $30,000 a year. It's a real cost, a real cash drain, that is far greater than the accountant's $20,000 depreciation charge. So your true owner earnings, the cash you could actually take home without harming the long-term health of your business, wouldn't be $80,000. It would be the $100,000 of pre-depreciation earnings minus the $30,000 of real-world maintenance costs, leaving you with only $70,000. By focusing on the accountant's profit, executives were deluding themselves and their shareholders about the true profitability of their enterprises. Buffett's introduction of owner earnings was a call to arms for intellectual honesty in fundamental analysis and a new standard for a CEO mindset in capital allocation. This pursuit of a more accurate measure of performance is a powerful antidote to a pair of cognitive biases, the law of small numbers and the availability heuristic. The law of small numbers describes our tendency to draw broad conclusions from small, insufficient samples of data. An investor sees a single EPS number and makes a sweeping judgment about the entire company's value. The availability heuristic is our mental shortcut of relying on immediate examples that come to mind. The profit number is readily available. It's the headline. The complex calculation of a company's true maintenance capital expenditures is not. It requires effort. It requires what Nobel laureate Daniel Kahneman calls System 2 inches thinking, the slow, deliberate, analytical part of our brain. Our brains are inherently lazy and prefer the quick, intuitive System 1 inch thinking. We latch onto the simple, available number. Buffett's concept of owner earnings is a forced exercise in System 2 thinking. It demands that you reject the easy answer. It forces you to dig into the footnotes of the annual report, to look at historical spending patterns, to think critically about the nature of the business. It is an act of intellectual rigor, a deliberate choice to override your brain's natural tendency to take the easy path. By committing to this more difficult calculation, you are gaining a significant analytical edge over the vast majority of market participants who are content with the readily available and often misleading headline numbers. So how do you, as a retail investor, apply this powerful mental model? Here is the blueprint for calculating owner earnings. Step 1. Start with the company's reported net income. You can find this at the bottom of the income statement. Step 2. Add back all non-cash charges. The main ones are depreciation and amortization, which are usually listed right on the cash flow statement. This step effectively gets you to a rough proxy for the cash the business generated before any reinvestment. Step 3. This is the crucial and most difficult step. You must subtract the average annual amount of maintenance capital expenditures. This is the amount of money the business needs to spend just to stand still, to maintain its current unit volume and long-term competitive position. The problem is that companies don't break this number out for you. They just report one number for total capital expenditures. So how do you estimate it? There are a few practical methods for the dedicated financial detective. One common method, popularized by Professor Bruce Greenwald at Columbia Business School, involves looking at the change in gross property, plant, and equipment, PP&E, over several years and adjusting for inflation and acquisitions. A simpler, more conservative method is to analyze the company's historical capital spending as a percentage of sales or assets. If a company has been spending about 5% of its sales on CapEx for a decade just to maintain its market position, that's a good proxy for maintenance CapEx. If you are analyzing a mature, slow-growing business, you can often use its total CapEx number as a conservative estimate for maintenance CapEx. The key is to think like an owner and ask, how much cash do I have to pour back into this machine every year just to keep it from breaking down? Step 4. The number you are left with is owner earnings. This is the true cash profit of the business, the amount available to be returned to shareholders or reinvested for genuine growth. This number, not net income, is the foundation for any serious attempt at valuing a business. The path of the 99% is to skip this difficult work and use a simpler but flawed metric called free cash flow. You'll see this number used by analysts and financial websites everywhere. Typically, it's calculated as cash flow from operations minus total capital expenditures. While this is certainly better than using net income, it has a critical flaw that Buffett's owner earnings formula corrects. It fails to distinguish between two very different types of capital expenditures. The first is maintenance capex, the money spent to stay in the same place. This is a true cost to the owner. The second is growth capex, money spent to expand the business, enter new markets, or launch new products. This is not a cost, it is an investment. A fast-growing company that is spending heavily on new factories to meet exploding demand might have a very low, or even negative, free cash flow. An investor using this simple formula might incorrectly conclude the business is unhealthy. Conversely, a stagnant, dying company that is spending nothing on its future might show a very high free cash flow, tricking the unsophisticated investor into thinking it's a bargain. The 99% either don't know this crucial distinction exists, or they don't bother to do the analytical work to separate the two. They are making their asset allocation decisions based on a number that can be wildly misleading. By taking the extra step to estimate owner earnings, you are operating on a higher plane of financial analysis, able to see the true economic engine of a business where others only see noise. The direct financial connection of using owner earnings is that it provides the single most reliable input for valuing a business. The entire practice of value investing rests on a simple idea. Calculate what a business is worth, its intrinsic value, and then try to buy it for a significant discount to that value. Most sophisticated methods for calculating intrinsic value, like a discounted cash flow (DCF) analysis, rely on forecasting a company's future cash flows and discounting them back to the present. If you use net income or the flawed free cash flow number as the basis for your valuation, your result will be garbage. It's the classic garbage in, garbage out problem. But if you use owner earnings, you are starting with a number that represents the true, durable, cash-generating power of the enterprise. Your valuation will be far more realistic and reliable. This allows you to make much smarter stock-picking decisions. It enables you to confidently buy when others are fearful, knowing you are paying a fair price for a stream of real cash. And it gives you the discipline to walk away from a popular, exciting stock when you calculate that its price has become detached from its actual ability to generate cash for its owners. This disciplined, cash-focused approach to valuation is the ultimate tool for protecting your capital and generating superior long-term capital gains. It is the core of the Warren Buffett strategy. The principles of following the cash and calculating owner earnings are not just academic exercises. They are powerful shields that protect you from the financial graveyards filled with the stocks of once great, profitable companies. These are the companies that graced the covers of magazines, whose CEOs were hailed as visionaries and whose stock charts looked like a straight line to the moon, right before they collapsed into nothing. Ignoring the reality of cash in favor of a seductive profit narrative is the most common path to these graveyards. We've already discussed the epic fraud at WorldCom, but there are countless other examples where the warning signs were flashing brightly on the cash flow statement long before the disaster struck. These case studies serve as harrowing reminders of the price investors pay for ignoring Buffett's central principle. To become a truly successful investor, you must study failure as much as you study success. And the history of financial markets is a museum of spectacular failures, all of them telling a similar story of accounting fiction triumphing over cash flow fact. Let's travel back to the mid-2010s and examine the meteoric rise and catastrophic fall of a company called Valeant Pharmaceuticals. For a time, Valeant was the darling of the hedge fund world, a new kind of pharmaceutical company. Its strategy, led by its aggressive CEO Michael Pearson, was simple. Instead of spending billions on risky, uncertain drug research and development, Valeant would grow by acquiring other drug companies that already had proven, successful drugs. Then, it would ruthlessly slash the R&D budgets of the acquired companies, and dramatically hike the prices of their drugs. On the income statement, this strategy looked like pure genius. Each acquisition was accretive to earnings, meaning it immediately boosted Valiant's reported earnings per share. The company created its own customized non-GAAP metric called adjusted EPS, which conveniently ignored many of the real costs associated with its acquisitions. Wall Street analysts fell in love with this number. The story was intoxicating, a brilliant, capital-efficient growth machine. From 2010 to its peak in 2015, Valiant's stock price soared by more than 2,000%, creating billions in paper wealth. But the financial detectives, the investors who followed the cash, saw a horror movie unfolding. The company's acquisition spree was funded by a terrifying mountain of debt, which ballooned to over $30 billion. The beautiful adjusted EPS on the income statement was an illusion. The cash flow statement told the real story. The company was not generating nearly enough real cash from its operations to service its colossal debt load. It was a house of cards built on financial engineering and price gouging. The moment its business model came under political and regulatory scrutiny, the whole charade collapsed. The stock price plummeted from over $260 a share to less than $10, an almost total wipeout. The investors who were seduced by the accretive earnings story were financially annihilated. Those who had looked at the cash flow statement and seen the massive debt-fueled financing cash flows and the insufficient operating cash flows knew to stay far, far away. The story of Valiant is a perfect illustration of two powerful psychological forces that lead investors into these traps: herd mentality and authority bias. Herd mentality, or herd bias, is our innate instinct to follow the actions of a larger group. When a stock like Valiant is soaring, and all the smart money hedge funds are piling in, it becomes psychologically painful to stand apart. The fear of missing out becomes overwhelming. It feels safer and more comfortable to run with the herd, even if the herd is stampeding towards a cliff. This is compounded by authority bias, our tendency to attribute greater accuracy to the opinion of an authority figure. In the case of Valiant, the authority figures were the highly paid Wall Street analysts with their buy ratings and the celebrated CEO with his compelling growth story. The average retail investor outsources their critical thinking to these experts. They assume that if these authorities are bullish, the company must be a safe and sound investment. Warren Buffett's entire career has been a testament to the power of resisting these two biases. He is famous for his ability to think independently and to ignore the clamoring of the crowd. His focus on the objective, verifiable data of the cash flow statement is a mechanism for overriding the emotional pull of the herd and the seductive narratives of authority figures. He trusts the numbers, not the story. This independent contrarian mindset is essential for avoiding blow-ups and achieving long-term investing success. To operationalize this contrarian mindset and protect yourself from the next Valiant or WorldCom, you need a practical checklist of warning signs. Think of this as your forensic accountant's red flag checklist, a tool to help you spot the discrepancies between the profit story and the cash reality. Red flag number 1. Net income is consistently and significantly higher than cash flow from operations. This is the single biggest and most important warning sign. If a company consistently reports profits that aren't turning into cash, you must find out why. Red flag number 2. Aggressive revenue recognition policies. Look at the balance sheet. Is a company's accounts receivable number growing much faster than its sales? This could mean the company is booking sales that it's having trouble collecting cash for, a classic sign of a business trying to artificially inflate its revenues. Red flag number 3. Frequent changes in accounting assumptions. Buried in the footnotes of an annual report, a company might disclose a change in how it depreciates its assets or values its inventory. These changes can be used to manipulate reported earnings. A pattern of such changes is a major red flag. Red flag number 4. Capitalizing expenses that should be expensed. This was the core of the WorldCom fraud. If you see a company in a service industry with suddenly exploding capital expenditures, it warrants extreme skepticism. Red flag number 5. using one-time events to boost operating cash flow. Be wary of companies that are selling off divisions or securitizing their receivables to generate cash. While not always a negative, it can be a way to mask a deteriorating core business. Red flag number 6. Relying on debt or equity financing to cover operating shortfalls. Look at the 3 buckets. If a company has negative cash flow from operations, but is staying alive because of a positive cash flow from financing, it means it's burning cash and depending on the kindness of lenders and new investors to survive. This is an inherently unstable situation. By methodically checking for these red flags in every potential investment, you are building a powerful system for portfolio protection. The path of the 99% is to be a momentum chaser. They buy what is going up. They fall in love with a hot story, a charismatic CEO, or a disruptive new technology. They chase performance without ever doing the hard work of fundamental analysis. They are the ones who piled into dot-com stocks with no revenue, who bought housing stocks in 2006 because real estate never goes down, and who chased the growth by acquisition story of Valiant. They are attracted to complexity and novelty. They love a company that is constantly in the news, making splashy acquisitions, because it feels dynamic and exciting. They don't stop to ask the simple, boring question that Buffett always asks. Are these acquisitions actually generating a satisfactory return on the cash being invested? They are seduced by the narrative of synergies and building a platform, corporate buzzwords that often mask a lack of financial discipline. The AOL-Time Warner merger in 2000 is the poster child for this folly. It was sold as a visionary combination of new media and old media. The story was epic. The financial reality was an unmitigated disaster that destroyed hundreds of billions in shareholder value because there was no underlying cash flow logic to the combination. The 99% chase these exciting stories. The path to wealth is to focus on the boring, predictable, and ever-growing streams of cash. The direct financial connection here is the most important one of all: survival. Investing is a long game. The magic of compounding can only work its wonders if you stay in the game. As Buffett famously said, the first rule of investing is, don't lose money. And the second rule is, don't forget the first rule. A single catastrophic blow-up in your portfolio, a stock that goes to zero, can be so devastating that it becomes mathematically impossible to recover. If you lose 50% of your capital, you need to make a 100% return just to get back to even. Avoiding these zeros is therefore even more important than picking the big winners. Learning to be a financial detective, to spot the red flags in the cash flow statement, is the single most effective skill for avoiding those zeros. This is the essence of defensive stock picking. It is the foundation of any serious wealth management plan. It ensures that you not only grow your capital, but, more importantly, that you protect it from the permanent losses that plague the portfolios of less diligent investors. Before you can win the game, you must first ensure you can survive it. And survival depends on your ability to distinguish the healthy, cash-generating businesses from the profitable fictions that are secretly heading for the graveyard. So what is the ultimate prize for this disciplined focus on cash? What is the grand purpose of becoming a financial detective, of mastering the cash flow statement, of calculating owner earnings? The purpose is to identify and acquire pieces of the greatest wealth creation engine ever designed, the compounding machine. A truly great business doesn't just produce cash. It produces so much cash that it can be used as fuel to acquire other cash-producing assets, which in turn produce even more cash, creating a virtuous, self-reinforcing flywheel of ever-increasing value. This is the secret to Berkshire Hathaway. It is not a collection of stocks. It is a collection of cash pipelines, all feeding into a central reservoir of capital that Warren Buffett, the master capital allocator, then strategically deploys to build or buy new pipelines. Understanding this final piece of the puzzle elevates you from a simple stock picker to an investor with a true CEO mindset, focused not just on individual assets, but on building a personal financial empire fueled by cash. The story comes full circle back to See's Candies. We've discussed how Buffett's cash flow analysis led him to buy the business in 1972. But the real lesson is in what happened next. That initial $25 million investment, as we mentioned, has since generated over $2 billion in cash for Berkshire. Here is the critical point. Because See's is not a capital-intensive business, almost all of that cash was free to be deployed elsewhere. It was not needed to maintain See's competitive position. So, that river of cash began to flow out of the candy business and into the Berkshire Hathaway corporate treasury. What did Buffett do with it? He didn't just let it sit there. He went looking for other wonderful businesses. In the mid-1970s, he took the cash gushing from See's and used it to buy a major stake in the Washington Post Company, another fantastic business with a dominant brand and low capital needs. Now he had two rivers of cash flowing into his treasury. In the late 1980s, he took the combined cash flows from See's Candies and the Washington Post and made one of his most famous investments, buying a huge position in the Coca-Cola Company, a global cash-generating behemoth. Now there were three massive rivers. A few years later, cash from all three of those and others was used to acquire a stake in American Express. And decades later, the torrent of cash produced by this entire collection of businesses was used to make Berkshire's largest acquisition ever, the Burlington Northern Santa Fe Railroad, a capital-intensive but incredibly durable cash generator. This is the Berkshire flywheel in action. It is a masterpiece of capital allocation. A small, initial investment in a cash-rich candy business provided the fuel to acquire a newspaper, which helped acquire a soda company, which helped acquire a railroad. It is a compounding engine of breathtaking scale and power, and it is all built on the single, foundational principle of identifying and owning businesses that produce prodigious and growing streams of cash. This long-term, multi-decade approach to building a compounding machine requires a mindset that is almost alien in today's world of instant gratification. It requires overcoming the powerful psychological bias of hyperbolic discounting. This is our innate tendency to prefer smaller, immediate rewards over larger, delayed rewards. Most corporate CEOs and most investors are victims of this bias. They are overwhelmingly focused on this quarter's earnings. They will make short-sighted decisions, like cutting the R&D budget, delaying necessary maintenance, or using accounting gimmicks to make this quarter's profit number look good, even if it damages the long-term health and cash-generating power of the business. They want the small reward now. Buffett has what economists would call an incredibly low time preference. He is the master of delaying gratification. He is perfectly willing to see Berkshire's reported earnings dip in the short term if it means making an investment that will produce a tidal wave of cash a decade or two in the future. This ability to think in terms of decades, not quarters, is a genuine superpower in financial markets. It allows him to ignore the manic noise of the short-term news cycle and focus on the long-term fundamental driver of all value, the sustainable production of cash. To cultivate this long-term CEO mindset, you need a final mental model. I call it the business as a cash pipeline framework. When you evaluate any potential investment, you must stop seeing it as a stock ticker that wiggles up and down on a screen. You must see it as a pipeline that you are considering buying a piece of, and you must ask yourself 4 questions about this pipeline. Question 1. How much cash is this pipeline generating right now? This is its owner earnings. This is the current flow rate. Question 2. How much do I have to spend just to keep this pipeline from leaking? This is its maintenance capex. This is the cost of ownership. Question 3. How much can the pipeline's flow grow over time? This assesses its future prospects. Is it a pipeline in a growing industry or a shrinking one? Question 4. And this is the most important. What does the management team, the pipeline's operators, do with the cash that comes out of the end of the pipe? Do they reinvest it wisely in building or buying other high-return pipelines, just like Buffett does? Do they return it directly to you, the owner, in the form of dividends or stock buybacks? Or do they waste it on foolish, overpriced acquisitions and corporate vanity projects, a process Buffett derisively calls diversification? A great investment is a well-maintained pipeline with a growing flow, operated by honest and skilled managers who use the resulting cash to create even more value for the owners. Viewing every investment through this simple, powerful lens will transform the quality of your decision-making. The path of the 99% is to be perpetually distracted from this fundamental reality. They chase growth at any price. They are drawn to the serial acquirers, the companies that are always in the news for buying another company. They see this activity as a sign of dynamism and success, without ever asking the hard questions about the price paid or the return on investment. They fall for the story, for the narrative of empire building. They forget that the purpose of a business is not to get bigger, it's to become more valuable on a per-share basis. A company that issues billions in new stock to buy a mediocre business might get bigger, but it often makes the existing shareholders poorer. The 99% celebrate the deal announcement. The wise investor waits a few years and analyzes the cash flow statement to see if the deal actually created any value. They have the patience and the discipline to focus on the long-term results, not the short-term headlines. This discipline is what separates those who build lasting wealth from those who are merely speculating. The direct financial connection of this final pillar is the achievement of true financial freedom. The ultimate goal of investing is not just to see your stock prices go up. It is to build a portfolio of assets that produces a stream of cash large enough to cover your living expenses, freeing you from the need to ever work for money again. That is the final promise. By focusing on buying cash pipelines at reasonable prices, you are directly aligning yourself with this goal. You are becoming a proprietor of capital, an owner of businesses that work for you, producing cash day and night. Over time, the relentless growth of that cash generation will inevitably be reflected in the market value of your holdings, leading to massive capital gains. But more importantly, you will have built your own personal compounding machine, a financial flywheel that, once it gets going, can provide for you and your family for generations. This is the ultimate CEO mindset applied to your personal finances. You are not a speculator renting stocks for a few months. You are the CEO of your own financial destiny, strategically acquiring cash-producing assets to build a fortress of wealth and security. This is the final and most profound lesson from Warren Buffett's lifelong dedication to one simple, powerful idea: follow the cash. You've made it through an immense amount of information, and what you've just acquired is more than a simple investing tip. It is a complete and total paradigm shift. You no longer just see a stock ticker, you see a business. You no longer hear a headline about profit and take it at face value. You now ask, but where is the cash? You have traded the blurry vision of the average market participant for the financial equivalent of X-ray vision, the ability to look through the surface-level accounting and see the true, beating heart of a company, its cash flow. This is a permanent upgrade to your mental toolkit, a powerful lens that will protect your capital and guide your decisions for the rest of your investing life. But this X-ray vision, this newfound ability to see the cash, is only the first half of the equation. Warren Buffett's genius isn't just in finding the wonderful cash-generating businesses, it's in what he does next. It's his ironclad discipline in knowing what price to pay for that river of cash. It's his ability to calculate a company's true intrinsic value, and his patience to wait until the market offers him a price that represents a deep discount to that value. Identifying a great business is one thing, buying it at a great price is another. And it is the combination of those two skills that creates legendary returns. The video that YouTube is showing you on your screen right now is the other half of that blueprint. It is the crucial bridge that connects identifying a healthy business with valuing it correctly. It's the vital link that translates your newfound understanding of business quality into a practical system for buying assets at a price that provides both a margin of safety and the potential for extraordinary gains. Many will stop here, content with this one powerful tool. But those who are truly serious about achieving financial independence, those who are committed to operating with a CEO mindset, understand that one tool is never enough. You need the full arsenal. The next step in your journey, the next piece of the map that connects what to buy with how much to pay, is waiting for you. Complete your education. Continue your ascent. Click the video.